Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Harsha Upadhyaya, who is the Chief Investment Officer, Equity at Kotak Mahindra AMC, and he's also the president of the AMC there. Harsha, thank you very much for joining us on BQ Prime. To begin with, we've seen a good build-up of crude happening over in the last quarter. Uh, as a fund manager, how do you position the portfolio because of the kind of impact that could have on many of the sectors and on crude derivative sector dependent sectors?
Clearly, one of the reasons for a strong move in the market was strong liquidity that we saw across the board, across segments over the last 5 to 6 months. Along with that, there was also a improvement that we saw in terms of the earnings trajectory, and which was expected to continue as we go forward. Now with crude moving up to $95 per barrel, clearly it's a red flag. There are many pockets of our economy which will get impacted adversely if crude remains at higher levels. So to that extent, yes, while we still believe that the earnings growth numbers are achievable, but definitely it's a red flag that we need to look at. May not be in the September quarter, but definitely in the December quarter, there would be some lagged impact of higher raw material or higher energy prices on the profitability of Indian corporates in our view.
What kind of earnings growth that you're looking in Q2, and which sectors do you think will be outperforming?
Most domestic sectors are likely to be more resilient than export-oriented or global-facing sectors, in our opinion. We do believe that for the year, financial year 24 and 25, we should be looking at somewhere in the mid-teens in terms of earnings growth number for the large cap basket. However, the expectations for the mid and small caps have been even higher in the region of 25 to 30%. I think that's where one needs to be a little cautious. Not only market has seen a very strong move in mid and small caps as compared to large caps, but also if the red flag that I mentioned, the increase in crude oil prices and hence how it's going to impact profitability, etc., is going to play out, then probably you're going to see more disappointments in the mid and small cap basket as compared to large cap basket. So that's where probably there is a bit of a risk in terms of market volatility. However, on the large cap side, even if you assume that there is going to be a little bit of pressure because of the crude oil prices or otherwise, given the valuations are more or less in the fair range of valuations, we do not think that there will be too much of volatility.
Harsha, as a fund house, you've seen a pool of capital coming in for mid cap and small cap companies in the last 3 to 4 5 months, where we have seen a lot of flows coming into some of the funds within the mutual fund and with directly to these companies. How do you see these flows? Do you see some signs of ebbing of flows? Because we've seen some correction also in these in these companies. And is it what is your view on the liquidity that many of these small and mid cap companies today have? In the past, there has been instances that investors used to get stuck because of lack of liquidity. Do you think that these companies are now fairly liquid, and so you have easy flow in and flow out of capital going into these companies?
Sajeet, clearly the liquidity remains an issue for small caps. May not be for all of the mid caps, but definitely some of the mid caps at least as compared to large caps. As a fund house, we have been advising investors to remain cautious on the mid cap basket because of the relatively richer valuations in that space. And also with the fact that if you look at last 1 year performance or last 3 year performance, especially since we are looking at a 3 year performance coming from the bottom of the COVID rally, you would definitely see very strong numbers, and one should not extrapolate those numbers to continue going forward. That's where we are advising caution, and we are also telling investors not to look at the short-term performance, not to come into mid and small caps from a short-term perspective. If one is looking at this basket, one should be looking at how Indian economy is going to grow over the next few years and come for maybe 5 years or beyond, and also in a staggered approach. Rather than putting lump sum money at these valuations. That's what we have been advising. But clearly, liquidity works both ways. Sometimes lack of liquidity takes stock prices to higher levels than what is warranted. And similarly, if that liquidity reverses, there is a risk of stocks falling more than warranted. So one should be aware of this risk, especially in case of illiquid or lower liquidity baskets.
As a fund house, when you select some of these mid caps and small caps, have you done an exercise of what is the kind of capex these companies are putting in? When is this going to come through? And is the valuation which has been given to them because of the kind of liquidity coming in, is it factoring in 3-4 years of earnings growth and sustained earnings growth?
See, clearly, it depends on different baskets or different sectors or stocks that we evaluate. I don't think it's a homogeneous trend in terms of either valuations or earnings growth. Clearly, we look at not only the business of the company, we also look at the management in terms of whether they are aligned to minority shareholders, what has been the track record in the past, what has been the bandwidth in terms of managing the business over a cycle or the years, etc. And finally, in all cases, valuation is a feature. So nothing of this changes irrespective of where the markets are. Definitely, when the markets are at reasonably higher valuations, one has to be even more cautious in terms of looking at some of these businesses or from a valuation angle, how to evaluate, etc. So that's an ongoing process. And clearly, we also keep liquidity that I mentioned in our mind when we are building portfolios, especially when you look at our mid cap or small cap strategy. We have been always following very, very diversified portfolio strategy just to mitigate any of the unexpected liquidity changes. So to that extent, we generally keep a portfolio of anywhere between 70 to 80 stocks and very well diversified in terms of the weights as well. So that's how we try to manage the overall portfolio risk and the market risk.
Mm-hmm. I was looking at your top holdings. It seems more tilted towards financial services, banks and financial services. Do you think the run up in banks and financial services is going to continue? The kind of earnings they have been coming out with, will that continue for another few quarters?
So clearly, banking and financial services have not performed as much as what we expected for the last 6 months or so. They have been moving sideways. There have been many other pockets of the economy which have done even better. So to that extent, given the current valuations, which are anyways inexpensive, we do believe that the recent underperformance of this basket gives us some kind of a cushion in case of a unexpected market volatility. And also, while there could be some pressure on net interest margins as we go forward, there is clearly a very, very strong trend in terms of the lending growth. That should lead to a better overall profitability. And when you look at this basket, this is likely to be one of the baskets where you will see a reasonably strong set of numbers in terms of earnings. There are absolutely no issues on the asset quality. So overall, I think it's a good space to be in. Yes, it has not worked as much as we wanted to be in the last 6 months or so, but that also gives a kind of a valuation cushion and one looking at this sector.
Okay, from the other point of view, there is IT which seems to be underweight. Means there's only Infosys in the top 10, if I'm not wrong. What's your view on IT? And the IT earnings are expected in the next week. How do you see IT's performance in Q2? Is it going to be subdued also, given the fact the kind of guidance we have seen from many of the companies? And when do you see the turnaround happening in IT?
Clearly, in terms of the earnings trajectory, we don't see anything exciting as compared to the market expectations for the IT sector. It may take maybe another couple of quarters for the entire industries to come back in terms of better business momentum. So at this point of time, clearly our focus has remained more towards domestic businesses, as we discussed earlier, where we believe that growth is resilient and also overall earnings growth is going to be much better as compared to many of the export-oriented or global-facing sectors, including IT. So to that extent, on a relative basis, we continue to be more focused on domestic businesses as compared to IT or some of the other export-oriented businesses.
Harsha, how do you look at consumer FMCG consumer? Do you see some pain there with respect to the demand coming from rural sector? Because the expectation was that the monsoon would bring in some kind of demand and consumption resumption coming from the rural segment. Do you see, given the fact that monsoon was almost near normal, but and not above, and and the spread was not as even as expected, demand from rural segment to be little bit sluggish in the second half?
Sajid, clearly for the past couple of years, we have seen rural segment not performing as well as the urban segment in terms of the consumption trends. The hope was this year's monsoon will probably give the necessary fillip to the rural consumption. And also the pre-election year, you see a lot of social schemes from the government also directed towards rural areas. So these two factors should have actually improved the overall consumption trend in the rural segment. That was the hope. But as we are coming to the close of monsoon season, it's clear that monsoon is unlikely to be one of the favorable factors for any resumption or any revival in rural consumption trends. At the same time, there is definitely going to be some positive impact of pre-election year spend that comes from our government like schemes towards rural areas. So it will be a combination of these two factors and how that's going to interplay and lead to overall consumption trends. Definitely, it's going to be slightly better than what we have seen in the last couple of quarters, but I don't think one can be very, very confident that it's going to be a significant change in the overall trajectory for rural consumption trends. So to that extent, I think it will still remain an area where you may not have a very large overweight in the portfolios, but incrementally you will start watching how this trend pans out, and accordingly probably you keep taking certain positions.
Asha, you mentioned about the fact that you expect the large caps to, have an earnings count of mid-teens in this financial year. So, which are the sectors that's going to drive that growth?
We have been very positive on auto and industrials, among many other sectors which are also likely to be very strong in terms of earnings. As we discussed, even financials can participate with a decent amount of earnings growth. May not be as strong as financial year 23 because this year we are going to see a little bit of pressure on the net interest margins. But nevertheless, I think these are the pockets which will continue to remain resilient in terms of overall growth as well as in terms of the earnings trajectory. And that's where most of our core positions are in terms of our portfolios at this point of time.
Which are the opportunities that you see in this market?
See, clearly, given the valuations where they are, I don't think there are pockets which are very, very attractive in terms of valuation. So it's always going to be more of a relative evaluation of where the earnings growth trends are going and what the valuations are. So from that perspective, I would say still domestic businesses tend to be scoring better as compared to some of the export-facing or global-facing businesses, given the fact that Indian growth has been more resilient than the global growth and also is expected to continue in a similar fashion. Beyond that, I don't think one can comfortably say that there is valuation attractiveness in sectors. And that these valuations especially, it's very unlikely that the entire sector is going to perform in a uniform way. It has to be more from a bottom-up evaluation of businesses and the valuations and taking a call on those. So clearly, I think the easy money that we have seen being made in the market is probably coming to an end. And from here on, it has to be more because of the way that you will evaluate businesses and look at valuations.
My question was with respect to the pharma space. You're talking about the fact that you are betting on domestic growth companies and not on exports. So within pharma, means are you bullish on it or you are a little apprehensive about the pharma?
Sajid, clearly, global growth is not going to be such a big factor for pharma exports because it's not directly linked to the global growth, but it's more a secular trend that we are seeing in that space. Having said that, we do not have a very strong view either on the positive side or on the negative side as far as pharma is concerned. There are some opportunities that we like from a bottom-up perspective, and cumulatively, probably when you look at it from a portfolio perspective, it is still kind of a neutral weight as compared to the benchmark weight, and that's where we are And within pharma, we do like some of the domestic-oriented businesses as compared to export-oriented, where again the growth rates are much stronger, and also some of the disruptions in terms of the margin profile that we had seen are kind of coming to an end. So overall, I think it is still not a sector which is very high on our priority, but we do have a couple of names in our portfolio, and cumulatively, it's more of a neutral weight, I would say.
What do you make of the commodity cycle, Harsha, and the recently announced Vedanta demerger? If you have any view on that.
Clearly, from a commodity perspective, we continue to remain slightly circumspect. Global growth has not improved. Yes, we have seen some of the pockets of commodities doing well. For example, crude oil doing much better than what everyone anticipated, but more so from a supply side reaction rather than demand being much higher. So, to that extent, I would say that along with all other global facing or global oriented businesses, even commodities seem to be in a space where probably it may not be the right time to take a very large overweight position. Yes, there are a couple of businesses that we like within commodities where we have seen a cleanup in terms of the balance sheet, and the financial health seems to be much higher this time around. And those businesses are the ones which will probably enter the new cycle in a much stronger way. So that's something that we are excited about. So there are a couple of names that we have in our portfolio, but otherwise, as an overall top-down perspective, we do believe that the commodities could remain under pressure for some more time.
Do you have a view on the Vedanta restructuring?
I would not be able to comment on individual stocks or groups.
Fair enough. I don't want to insist on that as well. But my final question to you is that as part of your portfolio, you've been a little cautious. There are certain pockets which you are bullish on. What is the kind of cash positions you're sitting on? Are you looking? Do you have enough dry powder? Do you see growth coming? You keeping that dry powder for any opportunity that is going to come by?
Sajeet, as far as our investment philosophy is concerned, we never really look at cash as a tool to manage performance because it's a double-edged sword, right? There will be periods where you will benefit by creating cash, and there will also be sharp pullbacks that will happen every now and then, and you will lose out that performance. So, to that extent, we are very cautious in terms of building cash. In case we are negative, probably we will look at pockets or sectors which would offer a little bit of more resilience and insulation from market volatility. So that's how we tend to construct our portfolio. So at this point of time, most large cap or large cap oriented portfolios have cash of about 2% or so. Whereas mid and small cap strategies have little more cash in the portfolio today, maybe at about 4 to 5%. But none of the portfolios we would like to create more cash looking at current market situation. Rather, we would go into defensive businesses or defensive sectors on a relative basis in case we need to deploy.
Have you taken up positions in defense sector, because that's one sector which has grown in terms of order book positions and also in terms of valuations?
Clearly, across our portfolios, we have been playing defense manufacturing as a theme for the last couple of years. Obviously, market has noticed it in the last few quarters, and there has been significant improvement in terms of stock performance. But we have always been very positive on this space from a long-term perspective and continue to remain bullish, although the valuations have moved up. So to that extent, probably putting incremental money may not be a good idea on these valuations. And from a longer-term perspective, however, the growth continues to be very strong for this basket.
Harsha, it was a pleasure talking to you today on Talking Point. Thank you very much for joining us on BQ Prime.
Thank you, Sajeet. Pleasure.